Hey everyone, Daniel here from Infravest. Just want to go through a quick article with you. This article was posted yesterday, June 7th, published by CNBC of this year. It is the year 2022, and I will post the link in the description for you to watch this. If you're on my YouTube channel, you'll see the link there. And the title of this link is World Bank slashes global growth forecast to 2.9%, warns 1970 style stagflation. So pretty interesting. I want to comment on a couple of things that were written in this article. So we'll start off here. The article starts off with saying the World Bank on Tuesday slashes global growth forecast and warned that many countries could fall into a recession as the economy slips into a period of stagflation, reminiscent of the 1970s, right? So we have World Bank coming out and discussing that growth forecast is going to be slashed. They basically came out and they said that they believe growth forecast is going to come down to 2.9%. Previously, especially this year, when previously they had a growth forecast of about 5.7% back in 2021, which is about 1.2 percentage points lower than the 4.1% predicted in January from, again, World Bank. So they're coming out with this report saying that they're seeing, they're expected that many countries out there, like for example, you're seeing a lot of issues, especially in Sri Lanka, with its debt crisis that they have, the food crisis that they're having, the crazy food shortages that are happening around the world, especially in the developing countries. The World Bank did issue and say that for many countries, recessions will be hard to avoid. So this is coming from the president of the World Bank saying for many countries, recession will be hard to avoid. And I think we're going to see globally a recession come into the markets, especially in North America as well. Because when you look at these developing countries, a lot of them, they're the ones that are providing us the goods, the commodities, the things that we depend on in our daily lives also, since the United States is a very big consumer of these exports that these developing countries rely on selling. This time it's going to be very difficult because you have less buying capability from everyone around the world as inflation continues to rise. So you're already seeing it in places like Sri Lanka. You're already seeing it in Iran also, where again, food crisis, issues with higher prices. You're seeing oil also. As I speak right now, I'm looking at the charts. Oil's around 122. It reached to a peak of almost, I believe it basically hit 123. We're talking about crude oil, WTI crude oil, reaching about $123 per barrel, right? We're close. We're getting there. We're inching up every single day, right? And nobody's covering this, right? Nobody's really talking about it so much. When you hear from the news media, it's been quite quiet. Yes, CNBC has posted this, but then you have World Bank coming out and talking about a potential recession. You're having certain banks from the US talking about low probability of recession. I don't think so. I don't think so. I think things are looking a little ugly, especially when you have these higher inflation, higher prices, when you're seeing oil move up, when you're seeing, food prices move up. This is definitely going to cause a lot of issues for not only developing countries, but also people within developed countries as they see their salary and income start to erode with these higher prices, right? Because when you have problems happening in the developing nations, don't think it's not going to trickle into all other countries as well, right? Don't think that an issue that's happening on the east side is not going to affect on the west side. It's definitely going to come. It's definitely going to be a very, very big problem. So with that being said, right, what do you do, right? What do you do in such situation? You have to be prepared. You have to be ready. We heard from Target. Check out my video that I posted about Target coming out and saying that inventory issues are going to be a problem for them because when they post their earnings, they came out with a revised revised report about their earnings in the future, right? Target had their earnings just not so long ago, and just recently this week they came out and said that hey, they're going to revise their earnings and their profits to much lower because they have so much inventory that they don't know what to do because you have demand coming down, right? So it's a pretty scary time, and you can expect that some people may prosper from those deals that Target and other company retail brick and retail corporations are going to give to the public. You can expect a lot of massive discounts because the demand is coming down. You have the rates moving up, higher rates. The balance sheet runoff that's happening with the Fed, that is causing the prices that you will see from a lot of these retailers to come down. So if you haven't seen it already, just watch out for that, right? If you have a Walmart close to you, if you have a Target close to you, if you got other retailers close to you, check out. There might be some deals that you might see that might be shocking to you because of what's happening right now with in terms of the inventory issue, in terms of the goods and services that are being more expensive, right? It's costing more, especially as commodities, depending on which commodities you're looking at, are also costing way more, which is affecting people, right? So World Bank comes out, warns people that you can get this 1970 style stagflation. What does that mean? That means lower growth and inflation continues to be elevated. And if you got lower growth and inflation continues to be elevated, it'll be very hard for corporations to continue to make profit, which will lead to what? Which will lead to possible layoffs. Yes, possible layoffs. They're not saying it. The Fed is not coming out and saying it explicitly. They do have in their projections that they believe that unemployment rate and jobs will stay stagnant, and they believe that growth will be robust, and the economy can handle it, and corporations can handle it, and jobs can handle it. But to be honest, I don't think so, especially when you're having these problems in the developing world. You're having this issue with higher prices, supply constraints, people getting affected by their bottom line and seeing more of their money that they would have saved basically shrink down to zero or even get into negative. You're having people, go out and are borrowing on credit cards just for their daily expenses, right? Don't think that everybody in the world has it easy, right? Don't think that when you look at the mass populations, they understand what's happening in terms of the situation that's happening with inflation and growth. And don't think that, a lot of them have this disposable income that they can buffer, right? Even the rich are going to feel it. Of course, they're going to have that buffer still with their disposable income and their savings, but the ones that don't, they're going to definitely feel the pinch really hard, and you're going to see demand get affected quite drastically. And that's why you might see companies like, for example, Dollar Tree, Dollarama, Dollar Store, right? A bunch of dollar stores that may do better in this time because people are looking for alternatives, right? Cheaper goods to purchase since they can't handle the current price increase, especially Walmart, right? Or even McDonald's, right? Why go out and dine out at an expensive restaurant, pay $100-200 for maybe one or two people when you can just go to McDonald's, have a dinner there, and for maybe $10 a meal, you're good and you're good to go, right? Especially if you have children, right? Why go and spend $50 or forget about $50, but let's say 20, 30, maybe $40 also for a plate for your kid who's going to eat maybe a quarter of the plate and not spend, not eat the whole thing. So why not just go to McDonald's for much more cheaper, and you can allocate your dollars a little bit more efficiently there, right? So that's what you're going to see a lot more issues come down in the next couple of months. This is where I think it's heading towards, right? So let's look at again this article from World Bank. So growth is expected to then hover around the 2023-2024 level while inflation remains above target in most countries, the report said, pointing towards stagflation risk. Okay, And now here's another one: Russia's invasion of Ukraine and the resultant surge in commodity prices, right? I find it so interesting every single time you have countries and even companies are doing this. The reason of our low earnings today, right? They'll have a press conference, they'll have a shareholders meeting. The reason for our low earnings today is due to the Russian-Ukraine war that's happening. I understand before you start shooting a bunch of hate comments to me and shooting me that hey, there's an issue with supply that came from Russia and Ukraine and especially with wheat and food prices as well. I understand from that point of view, right? But I just find it funny that there's a conflict going on the east side, and it's not a fun conflict, right? It's not something that is very happy or jolly that someone can can even talk about um, in a happy way. It's a very depressing news that you got a war going on the east side, and then you have these corporations blaming this war, right? Let's backtrack a little bit too, right? It's not just Russia and Ukraine issue that's happening there. It's not Ukraine's fault or anything like that. Yes, Russia did invade Ukraine, and it's a very, bad thing. But it is the surge in commodity prices, right? If you backtrack even before the war, it was self-induced by the government. The supply constraints that happened, right, was self-induced. The higher inflation that you're seeing today, yes, part of it is the money printing. Yes, part of it is this war that's going on. But the supply constraint, right, that has happened due to COVID, due to this virus, is what caused higher inflation, higher prices, right? So it's not just one single event, right? This came in the year of 2022, but this was a buildup of 2021 when the Fed kept saying inflation is transitory and it wasn't coming down because of what was created from the governments, the lockdowns, right? You locked everybody down, shipping slowed down, transportation became locked up also. China also, which is a big part of this whole equation as well, their supply issues were being exacerbated over there, which was then trickling also into the West. Because remember, for a decade long, right, China was exporting low prices. China was exporting disinflation, right? And all of a sudden, you have a lockdown, you have all these government policies, and you have China who has basically this zero COVID policy all of a sudden shut down, and you've got boats sitting there on the side, and work is not being not happening at the regular pace as it did before COVID, pre-COVID. Of course, that supply issue did drive the higher prices, right? So definitely, that's a very big component of it, and so it's not just the Russian invasion in Ukraine. Okay, there's more to this story, and so with this, you've seen commodity prices move up. You're seeing oil today move up in price, of course, with all of these external factors that are happening. And so let me go back to the article again. Prices have compounded. Existing COVID pandemic induced damage to the global economy, which World Bank said is now entering what it may be a protracted period of feeble growth and elevated inflation, right? So elevated inflation. So definitely, when you look at the US around 8%, inflation will tend to be elevated above its target of 2%. The Fed has a mandate to reach to 2%. So I do believe that with this coordinated effect between all the central banks around the world, it's not just the US. It's this coordinated effect around the world where you're getting a lot of the central banks raising rates, doing the balance sheet runoff, basically bringing the demand down so that supply can lower their prices, and hopefully also supply constraints get better, and the war of Russia and Ukraine gets better, and everything else gets better. But the idea is that on the demand side, when you're having this global coordination between the central banks, they are raising rates. They are trying to tackle inflation because everyone's going through the same problem, and that is to hopefully bring down prices lower, so that not only you have, let's say, Target and Walmart lowering prices, but for them to go and buy and add and buy more from their suppliers, they will also want to see lower prices too, which will cause suppliers to eventually lower prices. So the elevated inflation, right? Will inflation continue to rise from now? We'll have to see, right? We have to see depending on the data that comes out. But will inflation come down? I believe that that's where we're headed towards, and I believe that we could see slowly inflation come down because of the global coordination that we're having from the central banks to basically raise rates and dampen and basically stop people, slow them down from spending. You want to spend on essential. Don't go out like crazy like during COVID and buy anything because you've got stimulus money coming in, right? So they're going to try to reverse that move, so then that's where you can see inflation start to decline, but maybe not reach to 2% this year, to their target range that the Fed has, but it will probably come down quite a bit and we can see the effects of it. So we'll get more information as the months come by and as we get more data. So let me continue on with this article. The war in Ukraine, lockdowns in China, supply chain disruptions, and the risk of stagflation are hammering growth. For many countries, recession will be hard to avoid. Definitely, it will be. Um, let's see. Growth in advanced economies is projected to decelerate sharply to 2.6% in 2022 from 5.1% 2021, before further moderating to 2.2% in 2023, the report said. Okay, so let me scroll down a little bit more here, and let's discuss here 1970 style stagflation, right? So the present high inflation, weak growth environment has drawn down parallels with the 1970s, a period of intense stagflation which required steep increases in interest rates in advanced economies and triggering a string of financial crises in emerging markets and developing economies. The World Bank June report offers what is called a first systematic comparison between the situation now and that of 50 years ago. So again, in this article, you can probably pull up that report. It's the Global Economic Prospects report, and that's coming from the Global Bank. So you can just click on that and read more about it. It's in the article, on the CNBC article. I think it is about two paragraphs in, so close to the top. You can read that if you like. And scrolling down here, okay, so here's an interesting one, right? However, there are also a number of differences, such as strength of the US dollar, generally lower oil prices, and broadly strong balance sheets at major financial institutions, which present room for maneuver. Okay, this article here, this little paragraph here, I don't quite agree with, right? Generally, lower oil prices, well, actually, oil as we speak right now is 122 barrels, and it's approaching back to that 130. If things exacerbate some more, we can definitely see oil shoot up above 130. Now, the strength of the US dollar doesn't necessarily that means it's a good thing for the other nations on the east side, right? Because think about it. If you have debt to pay and the US dollar continues to rise, it's going to be harder for you to continue to pay off that debt, right? To continue to pay off that debt, and especially with a higher interest payment, right? Or interest rate. So that debt that you have, if it's especially in US dollar, that's not going to make things very, very simple for the rest of the world. Another thing, right? If you're a country that is importing goods from the United States, right? Or you're buying oil or anything, arms and ammunition, guns, etc., especially during this wartime, or any other products or goods or services in US dollar, again, it's not going to be easy. Right? Yes, you can manipulate your own currency if a country does that by raising the rates and pushing your own currency higher, but it's still going to be difficult for a country to go out and purchase goods from the United States. So what does that mean? That means exports for United States should come down because you have a higher dollar. It's going to be harder, especially in the times of higher inflation. So why would it be good for the economy as a whole? So we'll have to continue to watch that. And that's where I disagree a little bit here on that paragraph, that I don't think that this is generally a very good thing. And the other thing here is that broadly, another comment here, broadly strong balance sheets at major financial institutions as well, right? So now, when you look at major financial institutions, they're in the business of lending money. If nobody's going to come and borrow money, if there's if there's difficulty in people borrowing money, that might be a little bit of an effect for financial institutions as well, especially if rates are higher. Now, generally, if rates are higher in a good growth environment, then yes, that's very good for financial institutions. They will make money on higher interest payment. But now you've got higher rates and you've got lower growth and higher inflation. Generally, that should not be good for also the balance sheets on the major financial institutions as well. And that could lead to some countries and some institutions maybe defaulting with the amount of stress there is and the risk of higher prices of commodities, especially if you have any of these sovereign funds or these sovereign nations that go bankrupt during this time. Like, for example, right now, Sri Lanka's in big problems, asking World Bank for help. Iran, the same thing, asking World Bank for a bailout, right? If you get more countries doing the same thing, it could be a very scary time, especially living in there, and for those people who have money parked in those financial institutions. They are probably not gonna get their money back or get their money out from those banks if they go bust, right? So there's a lot of risks that play out here coming forward in the future, just like we see here from World Bank. Again, when we look forward from now till the end of this year, how are things looking when you look at the S&P, when you look at here NASDAQ? Right now, we are picking up from a bottom close to May's level. Can we continue higher or lower? We'll have to continue to watch the data. We'll have to continue to watch and see what the Federal Reserve has to say. And based on this, if this continues to worsen, inflation continues to worsen, I think definitely there is something that could break in the economy. And it's looking like the odds are more favoring recession and something to break in the economy. So let me know what you guys think. Let me know what you guys think about this article let me know what you think about the upcoming recession. Will we get it? Will we not get it? Will we curve it? Will the central banks, or especially in the US, do a very good job in curbing the recession? What do you guys think? Give a comment below. Give this video a like also as well. Share it with your friends. Let me know what they also think with these developments that are happening within the world. So I hope to see you guys around, and I'll see you in the next video. Thanks. Bye.